Hello friends, welcome to the English version session of our BFM unit number 12 theory portion. The topic is risk in banking business. So this is our English series video. Already we have covered till unit number 11. Today we are going to look deep dive into unit number 12, and now these are the topic which we are going to discuss. First of all, we will see the objective. What is the objective of this particular chapter? Then after we will see how risk is identified. Then the banking risk, banking book, trading book. I think book has been mixed here. The banking book and trading book of balance sheet exposure, and finally banking risks and definitions. So friends, in today's lecture, basically we will cover the first 3 to 4 portion, 3 to 4 topics, and the rest topic we will covered in the next lecture. So let's begin with. So first thing is that as you can see, risk identification in banking business. So bank don't just do one thing. They are involved in varieties of activity across different business line. For example, you have commercial banking where they give loan to the business, right? As you can see, you have corporate bank finance where they help big companies with things like merger or acquisition. We have retail banking where you and I can open saving account, and even investment banking where they manage a stock and bond. So these business line are broken down into a smaller group, right? So within each of these area there are different kind of financial services happening. For example, in retail banking you might have credit card, right, and personal loan under one umbrella. All of these different activities come with their own set of risk, and the bank has to identify and manage them. Now let's talk about the client segment. So bank don't just serve one type of client, they work with everyone. So bank don't just serve one kind of client, they work with everyone, from everyday people like us who is a retail customer, right, to a small and medium sized businesses. From retail customer to a small and medium sized businesses which are called mid market corporate, to large corporation, and even other financial institutions. So bank don't just serve one type of client, they work with everyone, from everyday people, right. And what is interesting is that the same service like giving out loan can look very different depending on who the client is, right. So service varies significantly across different client segment. For example, a loan to large corporate company, right, is way more complex and riskier than a personal loan to a retail customer. Because of this, bank need to be extra careful in identifying the risk when dealing with bigger client, right. Now let's talk about specialized financing. Now when we talk about lending, there is more than just your standard personal loan. Bank also get involved in something called specialized finance. This is where things get a little more high risk. One example is export financing. As you can see, one most basic example is export financing. Let's say a company is shipping goods overseas. So this is a company and this is shipping goods overseas, right now, and they need funding to cover that gap before getting paid. Bank step in to finance that, but the risk here are higher because it involve international trade, right, and different currencies. Then you have something called structured financing. Let's move to the next slide. Then you have something called structured financing, which is used for big high risk deal like financing a huge construction project or helping a company buy another company. These are not your everyday loan, and they require the bank to carefully assess all the risk before getting involved. So what are the key points which we have covered in these two slides? Let's wrap it up. So first of all, we have seen that bank operate in multiple areas like commercial, retail, corporate, and investment banking, each with its own risk. Client vary from everyday retail customer to large corporate entities, and the risk of same service depend on the client. Specialized financing such as export financing or project financing, it involve higher risk, so the bank need to be very careful, identify these risks before getting involved. Now let's move on to the next slide and let's talk about this financial product and derivative. So how bank manage risk by exploring the different financial product they offer and the various business line within the bank. Bank don't just offer simple product like saving account or loan, they also put together financial product and derivative to create custom solution for their client, right. So what they do, they create custom solution for their client, especially for those who need a specialized financing. Now, a derivative is a fancy word for a financial contract that gets its value from something else, like the price of a stock, like the price of commodity. You know about derivative, right? For example, let's say a company need a loan. So there is a company which need a loan, but they also want to protect themselves from change in the forex rate. So this company also want to protect itself from change in the forex rate. The bank might offer them a loan package with a derivative that locks in certain exchange rate, so the company won't lose money if the currency value change. Right, hopefully you have understood how financial products are linked with derivative. Now let's talk about the business line in banking. In your book you will say page table number 12.1, the same thing I am explaining. So bank divide their activity into different business line, and each of these focus on a specific financial service. Let's go over some of the key ones. The first is corporate finance. So in our corporate finance, bank have large company with activities like merger and acquisition, when one company buy or merges with another. Underwriting, where the bank help a company raise money, usually by selling a stock or bond. Securitization, as you all know, bank bundle up loan like mortgages and sell them as financial product. IPO, initial public offering. So this is when companies sell it a stock to the public for the first time. So for example, imagine there is a technology company, and this company want to buy a smaller startup. So there is a smaller startup with this technology company want to buy. The bank would step in, help with the financing, handle the paperwork, while also making sure the risk are managed. The next business line is trading and sales. So what are included under it? So this is the most fast-paced side of the banking. In trading and sales, bank handles fixed income like we say bonds, equity like we say stocks, commodities, for example we can say oil, gold, etc., and foreign exchange like dealing with different currency. They do also brokerage services, where they act middleman between buyers and seller. They hold proprietary position, which means the bank trade with its own money. For example, when you see news about bank making huge profit from trading oil or currency, that is part of their business line. Now there is something called retail banking. This is where most of us interact with banking. In retail banking, the service include retail lending like personal loan and mortgages, deposits, the account where we keep our money, trust and estate. So investment advice, so helping client grow their money through investment. Private banking, so a special service for wealthy individual. Card services like your debit card and credit card. Now there is something called commercial banking. See, commercial banking deals with business client, helping them with more complex financial need like project finance, funding big project like building a factory, real estate finance, loan for real estate development, export finance, helping business that ship product internationally, factoring, where the bank buy unpaid invoice from a company, trade finance, leasing, providing equipment or real estate leasing. For example, a company that want to build a new shopping mall would go to the bank for project financing. The bank would assess the risk and provide the necessary funding to get the project off the ground. Now, what are the key important points from these two slides? We have seen that bank offer customized financial product and derivative to meet the need of their client. Corporate financing help large company with merger, IPO and more. Trading and sales involve activity like trading stock, bond, commodities and currency. Retail banking serve everyday customer with services like loan, deposits and investment advice. Commercial banking focus on business client offering service like project financing and leasing. Now let's continue our discussion on this business line. The next is payment and settlement. So let's start with payment and settlement. This is how bank help external client. When I say external client, what I mean to say? I mean businesses, I mean individual move money around. So like payment and collection. So for example, when a company needs to collect payment from a customer, the bank handles that process. Fund transfer. This is simply transferring money from one account to another. Clearing and settlement services. This is when the bank ensures that all the financial transactions are completed smoothly between two parties. Think of it like this: when you transfer money from your account, right, to pay for something online, or when businesses receive payment from their customer, bank makes sure that money moves securely and quickly. The second kind of business line services that the bank offer is called agency service. Now let's talk about this agency service. Bank act like agent for the company and manage certain financial activities for them. So what are the areas? The first area is custody. So one important service is custody, where the bank provide escrow service. What is the meaning of of this? So this is when the bank hold money or asset until a certain condition is met. So what bank hold? Bank hold money, bank hold asset until a certain condition is met, right? Like in the real estate transaction. The next is our securities lending. So here bank lend out a stock or bond owned by their client to other investor. The next is we have corporate action management. So basically this involve handling event like a stock splits or dividend for company. For example, suppose you are buying your house. So suppose you are buying a house. The bank might hold the down payment in an escrow account until all the conditions of a sale are met. So what the bank do? The bank might hold the down payment in an escrow account until all the conditions of the sale are met. Now let's talk about this corporate agency and trust services. What is this all about? What is this corporate agency and trust services? Bank also offer services like corporate agent and corporate trust. This include, first thing is issuer and paying agent service. What does it mean? So where the bank help companies issue bond or pay dividend to the shareholder. The next is corporate trust, where the bank manage trust activity for the corporation. For instance, when a company issue bond to raise money, the bank might act like an agent to ensure that bondholder gets their payment. Now asset management. Asset management is another services under this business line. Okay, so asset management is all about managing investment for the client. There are two main types of asset management. The first is called discretionary fund management. So in the discretionary fund management, the bank manages investment fund on the behalf of client with full control. Client give back the freedom to make all the investment decision. So this could be for pooled fund, right? So this could be for pooled fund, so where many investors pool their money together to invest in large portfolio, or it could be for often segregated fund. So segregated fund means what? Where the money is kept separate and managed just for one client. So pooled fund means money in many investors pool their money together to invest in large fund. An example here could be a pension fund where the bank decide where to invest this money to maximize return for retirees. Now there is something called non-discretionary fund management. On the other hand, in non-discretionary fund management, the bank manages the fund but with limited involvement from client. The client has some say in where the money is invested, but the bank still handle most of the day-to-day operation, right? So we have seen the two types: the discretionary fund management, non-discretionary fund management, in which the bank manages the fund but with the limited involvement from the client. The client has some say, that is called non-discretionary. And in discretionary, the bank manages the fund with on the behalf of client with full control. Client has full control. And we have seen the two parts: pooled fund and segregated fund. In pooled fund means many investors pool their money together to invest in large portfolio. Now there is something called retail brokerage. This is another business line services. What is this all about? See, retail brokerage is when bank help individual client buy and sell a stock and other investment. There are two type of services here. The first is execution only service, where the bank only execute the buy or sell order placed by the client without giving any advice. So here no advice is given. And second is called full service brokerage, where the bank provide investment advice and manage the entire process of buying and selling. For example, if you want to buy a share of a company, right, so you could go to a bank brokerage service, and they would either simply place the trade for you or provide advice or what stock to buy. So what are the key takeaway from this particular two slide which we have covered just now? So we were discussing about the important business line of bank, and we have seen that the first is business line involve payment and settlement services which help money move between clients. Then we have agency services which include custody service like escrow, depository, securities lending, as well as corporate trust management. Then we have asset management services. So it helps client invest their money either with full control or limited involvement. When full control is there, it is called discretionary, and when limited involvement is there, it is called non-discretionary. And then we have discussed the retail brokerage. Retail brokerage, it helps individual buy and sell stock either through execution only service or full service. Now let's talk about the product line. What are the product lines in banking? Let's discuss. So a bank offer a wide range of lending product which are basically different types of loans and credit services. So first is called a standard lending product. What it means? See, these are the most common type of loan that bank offer. The example is short-term loan, means the loan that need to be repaid within a short time, usually within a 1 year. There are some long-term loan that are repaid over several years. So the key point here is several year, right? Like a business loan for buying machinery. Then there is something called demand loan. Demand loan are those loans which can be recalled by the bank at any time. Then we have lines of credit, right? When I say lines of credit, what I mean to say is that the like cash credit, bill purchase and bill discounting, where business can borrow money up to a certain limit whenever they need, right? So for example, if a business need fund, suppose a business need fund to cover its expense until they get paid by the customer. So business require fund until the customer pay them, right? So bank use what? Bank use bill discounting service. So in this case, bank use bill discounting service. Bank take the bill from the exporter, and on the behalf of that bill, the bank provides fund to the customer from exporter, right, where the bank pay them the money in the advance. Now let's talk about the retail segment loan. So basically, retail segment loan, a bank also offer loan specifically for retail customer, which means people like you and me. Now this can be auto loan, this can be house building loan, or another consumer loan, right? So now suppose you want to buy a car, so bank will offer an auto loan. Now there is something called off balance sheet exposure, which we can explore in our next slide. So what is this off balance sheet transaction? Bank don't just offer product that show up directly on their balance sheet. They also offer what is called off balance sheet transaction, which includes, you can see, guarantee. So guarantee where the bank promise to pay if the customer can't. Letter of credit. Letter of credit used in international trade to ensure that seller gets paid. Main purpose is whoever has exported, whoever has seller, he should get the payment. That is why letter of credit has been enacted. Now, for example, if a business is importing goods from another country, the bank might issue a letter of credit to guarantee the payment to the seller. Now, let's talk about the deposits and market product. So, deposit product and market product are the other keyword for them. So, deposit product vary depending on the customer need and includes things like saving account, fixed deposit. Saving account, when you keep your money and earn interest. Fixed deposit, where you lock your money in for certain period and earning higher interest. For example, if you want a safe place to store your money and earn a little interest, you might open a saving account. Now let's talk about the market product. Let's go into detail about the market product. See, bank also deal with market product, which are more investment focused. These market product are more investment focused. So which includes the things like fixed income security, like bonds, share, stocks, foreign exchange trading. These are where bank trade currencies. Then we have derivatives such as swaps and options. For example, a company might use a swap to exchange one type of loan payment for another to reduce risk or cost. Now, what are the key risks in banking business? So the first is operational risk. Operational risk refers to the risk of loss due to something going wrong in the bank day-to-day operation. This could be because of human error, system failure, or of an external event like fraud. Managing this operational risk is critical because it can lead to big financial losses and damage the bank reputation. For example, if a bank introduces a new service without properly training its staff, error could happen, resulting in financial loss, right, or upset customer. That's why bank invest in training and system to anticipate these risks and prevent them. Now, what are the key points which we have covered in the previous two slides? We have seen the lending product like a short-term loan, long-term loan, retail loan like auto and home loan. We have seen off-balance sheet transaction, which means guarantees and letter of credit which don't appear directly on the bank financial statement. We have seen deposit and market product like saving account, fixed deposit, bond, share, derivative, and we have seen operational risk. Now let's discuss the risk management, right? So the key goal for bank in managing risk is to maximize what is called risk adjusted expected return. So what does that mean? In simple terms, bank don't just focus on how much money they can make, they also look at the risk involved, right? They don't just look at the profit. Yes, profit is a key factor, but they also look at the risk involved. The idea is to get the highest possible return for a given level of risk. So I have fixed the risk, what highest possible return, what highest possible profit I can get. For example, a bank might choose to give out loans that have slightly lower interest rate but also have a lower risk of borrowing default, rather than giving higher interest loans that are more likely to result in losses, right? So now let's talk about the management practices. Risk management is not the same across all business line. Each type of banking activity, whether it is lending, already we have told you different type of business line, right? So each type of activity is like lending, trading, handling of balance sheet transaction has different level of probability and risk, which means the way risks are managed varies, right? For every business line, the risk management process, the risk management technique varied. For example, in retail banking, let me give you an example to make it more clear. In retail banking, when bank offer loan to everyday customer, the risk might come from people not able to repay their loan. While in trading and sales, the risk could be related to the change in the market price, like a stock value change, bond value change. So bank have different strategies to manage the specific risk in each area. right? So now let's break down the three main categories where bank focus their risk management effort. The first is banking book, trading book, and off balance sheet exposure. So what is it all about? So if we talk about the banking book include long term investment like loan and mortgage. So what is included here? Loan and mortgage, long term investment, right? These are the things that bank plan to hold for a long time. So remember, the key word here is long time, right? The main risk here is credit risk. The main risk that the bank face here is credit risk, right? What is the credit risk? The risk that the borrower won't able to repay the loan. Let me give you an example to make it more clear. For example, if a bank gives out a loan of lot of home loan, if a bank give lot of home loan and many homeowner can't make their mortgage payment, the bank could lose a lot of money. To manage this, bank assess the credit worthiness of borrower before approving loan and might also require collateral like house itself to reduce their risk, right? So this is all about the banking book. Now let's talk about something called trading portfolio. As you can see, just move to the previous slide. I think we are discussing the previous slide only. Yeah, trading portfolio. What is trading portfolio? Trading portfolio consists of those assets that the bank buy and sell regularly, like a stock, bond, currency, right? These things bank buy and sell every day. The risk here is mainly market risk. In banking book, we have seen the risk was credit risk, but in the trading book, the risk is market risk. The risk that the value of these assets will go up or go down because of changes in the market. For example, if a bank hold a lot of shares in the company, right, the stock price suddenly drop, what happened? They could lose a lot of money. To manage market risk, bank buy hedging strategy. You know about hedging strategy, right? Like financial product like derivatives that protect them from big risk. And the third is the off balance sheet exposure. Bank also deal with off balance sheet exposure, which are getting things like guarantee or letter of credit that don't appear directly on their balance sheet but still carry risk, right? So now let's discuss these in detail. Let's discuss the banking book in detail in the next slide. So friends, let's see. Banking book is where bank hold long term asset and liability that they don't plan to sell right away. Already I have told you, long term asset and liability, right? This includes things like loan and advance, right? Deposits from customer and borrowing from commercial other bank. In simple term, banking book is where bank keep things that it intends to hold on to for a long time, unlike the trading portfolio, which is more focused on short term buying and selling. What are the characteristics of asset and liability? Let's see. First thing is held until maturity. Any asset and liability in the banking book are usually held till maturity. For example, if a bank gives out a home loan, it expects the borrower to repay the loan over 10 or 20 years, meaning the loan stays in the banking book until it is full paid off. Now, actual accruing system is applied. What does it mean? Another important characteristic is accrual system. What does that mean? It means that the revenue is recorded when it is earned. Revenue is recorded when it is earned, even if the bank has not received the cash yet, and the expenses are recorded when they are incurred, even if the bank had not paid out yet. For example, if the bank earned interest on a loan in December, suppose if the bank earned interest on a loan in December but does not receive the payment until January, it has not received the payment until January, it is still record that income in December under the accrual system, right? So that is what it use, accrual system. No, not subjected to MTM, mark to market accounting. What it mean? See, unlike trading asset that are constantly adjusted based on market value like mark to market, banking book asset are not revalued based on the daily price change. The next is capital charge on credit risk. So lastly, the banking book attract a capital charge on credit risk, meaning that the bank need to set aside some capital to cover the risk that borrower might default on their loan, right? So already I have told you it is exposed to the credit risk. However, it does not attract capital from market risk because the assets are not sold frequently. Now, what are the risk in banking business? Already we know. What are the risks in banking business? So main type of risks which are in the banking business, you can see. The first is liquidity risk. Liquidity risk occur when there is a mismatch between the maturity date of the bank asset and liability. For example, if a bank give 10-year loan but it has to repay the deposit in 1 year, right? Repay the deposit in the 1 year, it could face a liquidity shortage because the loan is not due to be repaid yet, but the deposit need to be returned. So whenever there is a maturity mismatch dates of the bank asset and liability. It will result in the liquidity risk. Then we have something called interest rate risk. See, interest rate risk happen when the change in the interest rate affect the bank profitability. Bank earn interest on loan and pay interest on deposit. If the interest rate goes up or interest rate goes down during the time they are holding this loan or deposit, it can affect the net interest margin, the difference between the interest they earn and the interest they pay. For example, if a bank issued a loan at a fixed interest rate, say suppose 8%, but interest rate rises, the bank will earn less compared to the market when it will affect its profit. So this is how interest rate affect the profitability of the bank. Next we have default or credit risk. You know credit risk. So credit risk is already you know that the risk of borrower won't repay their loan, leading to the losses for the bank. For example, if a customer takes out a loan but later faces financial difficulties and can move apart. So operational risk, you know, it occurs from human error. So what are the key points which we have covered in the previous two slides? We have seen the banking book hold long-term asset and liability like loan and deposit. Accrual system accounting is used where income and expenses are recorded when they are earned or incurred, not when the cash is received. Banking book faces more 4 type of main risk in banking book. Liquidity risk due to mismatch, maturity mismatch, interest rate risk from changes in the interest rate. So friends, we end the first lecture here on, and in the next lecture we will discuss our trading book. If you want to get such kind of videos in English, you can WhatsApp me on this particular number. We are covering each and every chapter of BFM in English language so as to help those people who face difficulty in understanding the Hindi. If you want such type of lecture, you can WhatsApp me on this particular number. Let me write down the number again. Thank you.